Focusing in a little bit more now on foreign exchange risk. There are three types of foreign exchange risk. We've got economic, transaction, and translation risk. Economic risk, first of all, the thing to look out for here is long-term, the phrase long-term in questions. Economic risk, for example, if we invest in an overseas location, and because of the long-term relative competitiveness of those two different countries, it means the exchange rate is moving gradually in one direction, then we may either gain or lose in the long term because of that movement in the exchange rate. Now, that is distinct from individual transactions, so that really affects the longer term net present value of those overseas operations. So that's economic risk. Translation risk next comes from having financial reporting requirements. That means that at a point in time you have to retranslate, hence translation risk, I guess, retranslate foreign currency assets and liabilities for reporting purposes. So for example, if I sell something to an overseas customer and then at the year end they haven't paid me yet, I've got an overseas receivable sitting on my balance sheet. I would need to retranslate that receivable for reporting purposes. And if that receivable changes in size because of what's happened to the exchange rate, then I will end up with a profit or loss due to foreign exchange, which will affect my reported profits. And of course, anything that affects reported profits potentially affects share price. It could also affect things like banking covenants as well. So quite often when you take out a loan, within that loan agreement there'll be covenants that say you're not allowed to borrow more than X percent going forwards. You've got to keep your interest cover higher than a certain number, for example, and all these ratios are based on financial reporting type information, typically off published accounts. So anything that affects those published accounts may affect your ability to stay within stated loan covenants. We also have transaction risk, and transaction risk is to do with an individual sale or purchase. So if I sell something to an American, when they pay me in US dollars, then those US dollars, when I translate them to my domestic currency, may be worth more or less sterling than I originally thought, whatever my domestic currency is, because of the movement in the foreign exchange rate. And that is where quite often formal hedging will need to be undertaken. So buying futures, forwards, options to remove our exposure to that movement in the exchange rate. Investing overseas, though, gives us far more risks other than just foreign exchange currency type risks. There's also political risk. We're exposing ourselves to an overseas regime. It depends on where we're investing. If it's in a very volatile country, then that political risk could be quite extreme. A change in the administration of that country may mean assets are seized, or it could mean that assets are potentially destroyed if there's civil unrest. But even if it's not in a relatively volatile part of the world, we're still exposing ourselves to a government that we weren't exposed to before, which means that policy could change in relation to things like foreign investors and how we tax them, for example, and how much they're allowed to export into that location. So political risk is something that needs to be identified. Homework needs to be done up front to make sure we understand what the political risks are, and that needs to be formally managed. Product risk and cultural risk. In overseas locations, they often speak a different language. They have different customs and tastes and laws. And all these things can create issues for us. For example, we may have different regulations as far as product safety is concerned, which might mean we have to change the design of our product to be able to fit with local needs. We may misjudge the local markets. Just because a product works in our domestic market doesn't mean that people are going to want to buy it overseas. And an obvious way around this is to do your homework up front and maybe even employ the services of a particular consultancy to review your plans before you go ahead, and that can help to manage that risk, but it will never eliminate it entirely.